Hello traders, welcome back to the Forex Geek where we dive deep into the tool that can help you make smarter trading decisions. And in today's video, we are going to be talking about the diamond continuation pattern, a powerful chart pattern that can significantly enhance your trading strategy. This pattern is known for its ability to signal the continuation of trends, providing you with the opportunity to capitalize on the market movement with confidence. By the end of this video, you would learn and understand how to identify this pattern on your chart and how to implement effective this pattern to your trading strategy to maximize your profit. So stay tuned and watch till the end to unlock the full potential of the diamond continuation pattern in your trading arsenal. Now we have to first of all start by understanding what the diamond continuation pattern is. The diamond continuation pattern represents a unique formation of price action that occurs during a strong market trend. It can be either a bullish trend or a bearish trend. It just has to occur from a strong market trend. When you spot this pattern on your chart, it typically signifies a temporary pause in current trend before price continues in the original direction. Now let's assume price was making a series of higher highs, was making a series of excuse me making a series of higher highs and a higher low. When price was making a series of a higher high and a higher low, price decided to pause in price, creating another chart pattern within the trend. And this chart pattern is like this. It's exactly what we are looking at. You see price contracts a little bit before it expands, making both higher highs and lower lows before it contracts again and breaks out. So this exactly is what we should be looking for on the chart, this particular pattern. Now let's see this on the real market chart. And as we can see from this example, price was trading to the downside. This chart is making a series of lower lows. Price is breaking structure at this area. And as we can see, when price is breaking structure, it means to the downside, it means we are in a down trend. And when we reach this particular point in the market, we can see price decided to contract a bit before it expanded, making a series of a lower low. Price made a lower low before making a higher high, before it started contracting, making series of mini higher lows and higher highs, higher lows and higher highs, before price eventually broke out of the diamond pattern. And as we can see, if we draw our trend line, we can spot this diamond pattern. This is exactly the diamond pattern on our chart. Trying to mark it out so that we can thoroughly understand what this pattern is all about. So this is basically what the pattern is. This, it mustn't be clean, but you just need to have the concept of market contracting and expanding. The pattern shows two main types, in an uptrend and in a downtrend. The uptrend, the bullish diamond continuation, forms when price action creates expanding and then contracting price swing, a resembling a diamond. Similarly, in a downtrend, the bearish diamond continuation follows the same principle but signals a continuation. Now let's see this in an uptrend. This is presently in an uptrend. This marks an uptrend continuation. As we can see, market is trending to the upside and we spotted our pattern in our uptrend, while this was spotted in our downtrend. If you look closely, you can see price contracting and expanding, creating our diamond pattern. This is exactly what our diamond pattern is all about. Lower lows, lower highs before the market contracted and made series of higher lows and higher highs. This is exactly what the pattern is about, as we can see. While in case of a bearish continuation, this is the same with the pattern. Comes like this, creating a series of, this is a lower low, created a lower low, a higher high, a higher low, is in the same bearish market before contracting and making series of lower lows and lower highs in the market. So this exactly is what our pattern is all about. Forming a little bit of our diamond. It's not always going to be clear, but you just need to know the concept of market expanding before contracting, then breaking out in the intended direction of the trend. So this is exactly what we are going to talk about in our chart today. Now, to identify this pattern accurately on your chart, you have to look for key characteristics. Like I said, a clear trend preceding the pattern. There is a clear trend, and as you can see, that price is trading in an uptrend, making series of higher highs, higher lows, higher highs, higher lows, higher high, proving that yes, we are in a sustained bullish market. So this is what we are looking at, the trend, the present trend of the market. So since we have established the fact that we are in a bullish market, we would look for price swing that widens and narrows, forming the diamond shape. As we can see, this price swing widened before it narrowed down to form the diamond pattern. Like I've marked out the resistance and the support area on the diamond pattern. We also use our volume to indicate the decrease of the pattern as the pattern form. As we can see, the decrease in volume at this area as pattern forms. Before the pattern, there was an increase in volume to take the pattern up, but when the pattern was forming, you can see a reduced volume in the market. Then we can see the pattern should be symmetrical on both sides. They should be symmetrical on both sides. Now let's see how we can trade this pattern. Trading the diamond continuation pattern effectively requires a clear strategy to capitalize on its potential, and here is how you can approach trading this pattern with confidence. First, you focus on the breakout. The key to trading the diamond continuation pattern is waiting for a confirmed breakout from the diamond structure. Now, for a bullish diamond, you should look for a breakout above the resistance. In a bullish diamond, the breakout should occur above the resistance, while in a bearish diamond, the breakout should occur below the support. The breakout should occur below the support level. Once you have identified the breakout, it's time for you to set your entry. You enter the trade as soon as the breakout is confirmed. As soon as the breakout is confirmed, you enter your trade. You can either wait for price to come back to retest that area price broke out from before you take your trade, or you mark out that area price broke out from as a new support before you take your trade, as the case may be. Now, if I'm to enter my trade, as I noticed price broke out from this area, I would be willing to wait for price to come back to retest this area. When price retests this area, I will enter the price and I'll put my stop loss just below the trend line, just below the line, my resistance area. I'll put it just below the area, or we can put it at the lowest point of the area. This is where we set our stop loss. To protect the position, you have to place the stop loss outside the opposite side of the diamond pattern. So the low here should be a perfect example of where to put your stop loss. And this stop loss is a placement for minimal risk in case the market suddenly reverse against us, because there is no pattern that is 100% foolproof. Finally, you have to determine your profit target by measuring the height of the diamond. Your profit target can be the height of the diamond, where maybe it's retest from, or where you expect price to aim. This is a targeted region where price broke out from before it came back to retest. So at this area in price, we will just put our target and calculate an estimated amount from our measured length that price broke out from. And as you can see, this is exactly 1:2. You can also decide to set a profit target of 1:2, as the case may be. You have to also project the distance from the breakout level to set a realistic profit target. Now let's see in case of a bearish trade. In a bearish trade, the moment price break out from that area, you can wait. Sometimes price might not retest. You can decide to enter at the breakout, put your stop loss just at the breakout from the support. You put your stop loss above the recent high of that diamond pattern, or you can put it in a more conservative area, the highest point of that breakout of the diamond pattern. Then you set a realistic profit target. You can target the height of the diamond pattern, then you set it as your first profit target. You can also use a trailing stop loss method, as the case may be, or you can decide to target 1:2 as the case may be. Depending on how you ever want to take your trade and leave your trade is all up to you. But at minimum, you should be taking a trade that gives you 1:2 risk to reward ratio. Remember, always adhere to proper risk management practice. Ensure that your risk to reward aligns with your trading plan to maximize potential gains while minimizing losses. Alright traders, we have come to the end of this video. Engage with us in the comments below. We want to hear about your experiences. If you found this video helpful, do not forget to like, subscribe and turn on the notification bell so that you would not miss out on any or more trading tips and